How much house can you actually afford? I had set my limit at $350,000 because that mortgage fit beside retirement contributions, taxable investing, and cash reserves. Then the bank approved $480,000, and the mortgage that followed stayed current by consuming the taxable investing, cash reserves, and future income that were supposed to keep the rest of my financial plan moving. My salary was $120,000, but I never used the full paycheck to measure affordability. Retirement contributions left before the deposit reached checking, and $1,200 moved into a broad market index fund every month. The mortgage had to fit after both transfers. I kept the down payment in cash and the emergency fund. My plan required 6 months of expenses to remain available after closing costs, prepaid escrow, and the first payment. $350,000 was the highest price that preserved all of it. I entered the mortgage application with that ceiling written into my budget. The lender collected pay stubs, tax returns, bank statements, retirement balances, and my brokerage statement. I expected the underwriting result to confirm the range I had chosen. The first request was routine. I sent another bank statement, explained the recurring brokerage transfer, and confirmed that the cash balance was not borrowed. 2 days later, the pre-approval letter arrived with a maximum purchase price of $480,000. I called the loan officer because the approval was $130,000 above my limit. The income, credit profile, down payment, and debt-to-income ratio had all been entered correctly. The lender was comfortable with a payment I had never allowed into my plan. I reopened the affordability worksheet. The version started with take-home pay after taxes and retirement contributions, then subtracted brokerage investing, insurance, utilities, and a reserve for irregular expenses. I copied the file and created a second version using the lender's maximum. The new version still looked manageable. The projected payment met debt-to-income limits, but preserving investments, reserves, and irregular expenses still produced a monthly cash flow shortfall. The worksheet showed the shortfall, but not which commitment would eventually absorb it. I lowered the test price to $400,000. The payment remained below the bank's limit, and the cash required at closing stayed within the funds I had available. Compared with $480,000, the new figure looked restrained. The next estimate used $425,000. I kept the same down payment percentage and watched the mortgage balance, interest cost, escrow, and cash flow change together. The plan tightened, but preserving every commitment still left a shortfall. That was enough to change how I read the original ceiling. $350,000 had represented the maximum price that protected my investing rate and liquidity. After the pre-approval, it started to look like unused borrowing capacity. I changed the maximum price in the search portal from $350,000 to $400,000. I kept the mortgage worksheet open beside every option and entered the expected loan balance, down payment, escrow, and cash remaining after fixed expenses. I was still using finance to make the decision, but I had changed the benchmark. One property was priced just below $400,000. The projected payment fell within the pre-approved range, preserved the retirement contribution, and left the brokerage transfer untouched on paper. I added it to the shortlist because it appeared to answer how much house can you actually afford without using the full approval. By the end of the week, I had 2 affordability models saved under different names. One protected the financial system I had built before the mortgage application, and the other tested how far that system could stretch inside the bank's approval. I had not made an offer, but I was no longer treating my own limit as the final answer. I kept the $400,000 worksheet open for 3 days before changing anything else. The payment was higher than planned, but the bank had already approved more, which made the difference feel manageable. By then, how much house can you actually afford had become a question I was answering with the lender's ceiling instead of my own cash flow. The first offer I prepared was just under $400,000. I kept the down payment at 20%, which preserved the rate quote and avoided mortgage insurance. The mortgage balance was larger than the one in my original plan, but every line stayed inside the pre-approval. The seller countered, and I raised the offer by $12,000. I did not revisit the monthly budget because the increase looked small beside the price. That was the first time I changed the debt without rerunning the full cash flow. The accepted price was $412,000. My down payment increased, the loan amount increased, and escrow changed with taxes and insurance. I treated the difference as negligible once the mortgage was fully spread across 30 years. The lender issued a revised loan estimate. Principal and interest came in above the figure in my first worksheet, and escrow added property taxes and homeowners insurance. The total was still payable, but it no longer fit beside every transfer I had protected when the process began. I did not reduce the retirement contribution because it came out before the paycheck reached me. I also left the brokerage transfer unchanged because changing it would make the trade-off visible. Instead, I lowered the amount I planned to keep in checking after each pay period. That adjustment worked until the closing disclosure arrived. Prepaid taxes, insurance, lender fees, title charges, and escrow funding pushed the cash required above the number I had carried. The extra cash had to come from the reserve I had promised myself I would not use. I transferred the additional amount from savings and left the brokerage account untouched. Keeping the investments intact made the decision feel disciplined, even though the cash cushion was thinner. I was protecting the portfolio balance while weakening the liquidity that allowed me to leave it invested. The rate lock expired before the file was ready to close. Extending it cost more than expected, but allowing the lock to expire would have exposed the mortgage to the lender's then current pricing and could have delayed closing. I paid the extension fee and added it to the one-time costs. At closing, the mortgage payment was no longer an estimate. Principal, interest, taxes, and insurance would leave my account every month before brokerage contributions, travel, repairs, or other flexible expenses. I signed because every number remained inside the approval I had accepted. The first payroll deposit after closing looked normal. Retirement contributions had already been withheld, and the scheduled brokerage transfer was still waiting to clear. I left both untouched because I wanted the mortgage to prove it could fit without changing the system. Then the first payment posted. The checking balance fell farther than it had in any ordinary month, and the margin after fixed expenses was almost gone. I moved money from savings to prevent the brokerage transfer from leaving the account too low. That transfer was easy to explain as a timing issue. The cash reserve was still depleted by closing, and the first months of ownership included expenses that would not recur. I expected the next pay cycles to restore the difference and kept every automatic contribution in place while waiting for the budget to settle. The next month, the mortgage posted again without the closing costs around it. The payment still consumed most of the cash left after taxes, retirement, insurance, and normal expenses. For the first time, I could see that the approval had not increased my income. It had only decided which part of my financial plan would adjust. 3 months after closing, the mortgage had settled into the same position every month. The brokerage transfer was now the only large commitment that depended on what remained. I kept the full transfer scheduled through the first quarter. Twice, I moved cash from savings before it cleared because checking was lower than I wanted. I called both transfers temporary and left the automatic investment unchanged. The annual bonus arrived in the spring. Before the purchase, most of it would have gone into the taxable brokerage account after taxes. This time, I divided it between the cash reserve, escrow, and expenses delayed since closing. The brokerage account received less than 1/3 of what I had planned. I still treated the deposit as progress because some money reached the account. I compared it with 0 instead of with the contribution schedule I had replaced. A few weeks later, the lender completed the first escrow review. Property taxes and homeowners insurance were above the estimates used at closing. The mortgage payment increased, and the escrow account showed a shortage that could be paid immediately or spread across the next year. I paid the shortage in full from savings because I wanted the monthly payment closer to the original figure. That protected cash flow for the next 12 months, but it reduced the reserve again. I was using liquidity to keep the mortgage looking unchanged. By summer, the emergency fund was below the level I had set before applying for the loan. There had been no major repair, income loss, or unusual expense. Closing costs, escrow adjustments, insurance, and ordinary ownership costs had been enough. I reduced the monthly brokerage transfer from $1,200 to $700. The change released cash immediately, while the consequence remained in the future. I updated the budget, but left the long-term projection based on the original contribution. My retirement contribution stayed unchanged, and I used that to defend the decision. I was still saving through payroll, still holding the index funds already purchased, and still making every mortgage payment on time. The purchase looked affordable because none of the visible accounts had failed. The trade-off appeared in the taxable account. Contributions were smaller, dividends bought fewer shares, and the balance depended more on market movement than new capital. I had not sold anything, but the account had stopped receiving the cash flow that built it. I tried to restore the difference through smaller monthly cuts. Instead of changing the mortgage, travel was reduced, irregular expenses were delayed, and more purchases moved to later pay periods. Each change helped briefly, but none created enough room to restore the old brokerage transfer. The next raise was supposed to solve that. When it arrived, the higher paycheck first absorbed the mortgage increase, insurance, and the reserve I was rebuilding. The amount left for investing was smaller than I had expected. That was when "how much house can you actually afford" became harder to answer. I could afford the mortgage because the payment cleared every month and the loan remained current. I could not afford it without asking the rest of my financial plan to wait. By the end of the first year, I had made every payment and avoided obvious financial distress. The retirement account was growing, the brokerage account remained invested, and the emergency fund was still positive. But the system that existed before the mortgage was no longer moving at the same speed. I opened the original worksheet beside the current account balances. The purchase had not caused one large financial failure. It had redirected smaller amounts before they became investments. I was ready to calculate what the larger mortgage had cost beyond the payment itself. How much house can you actually afford? I returned to the original worksheet and replaced every estimate with the amounts that had left my accounts. The price was $412,000, but the larger mortgage had changed far more than the payment. I started with the cash used before payments began. The higher price required $12,400 more for the down payment than my original $350,000 plan. Closing adjustments, prepaid escrow, and the rate lock extension reduced the reserve again. Then I compared the monthly cash flow. Principal, interest, property taxes, and insurance were taking about $400 more each month than the original budget allowed. That difference had looked manageable during underwriting because it was measured against gross income. The brokerage statements showed where the pressure had landed. I had planned to invest $14,400 during the first year, but the reduced transfers left the taxable account several $1,000s short of that target. The missing contributions never bought another share of the broad market index fund. The annual bonus created another gap. Before the mortgage, most of the after-tax amount would have increased the brokerage account or strengthened the cash reserve. After closing, it covered escrow, replenished savings, and absorbed expenses the monthly income no longer carried. By the end of the first year, more than $20,000 had been redirected from liquidity and investing. None of it appeared as missed payments, consumer debt, or a financial emergency. The mortgage looked affordable because other accounts had absorbed the difference. The second year followed the same pattern. By the third year, the taxable account was almost $40,000 below the original path. The gap included contributions that never entered the market and returns they never earned. Every payment cleared, but the cost was now visible outside the mortgage statement. I compared the purchase with the $350,000 ceiling I had set before the pre-approval. The smaller mortgage would have preserved the brokerage schedule and left more cash after closing. It also would have reduced the income committed before each month began. That comparison answered, "How much house can you actually afford?" more clearly than the lender's approval. After 3 years, I listed the property and prepared to reduce the housing cost. The sale price was higher than what I had paid, but the remaining mortgage balance and transaction costs absorbed most of the increase. The equity I received did not replace the contributions missed along the way. Appreciation had helped, but it had not made the larger purchase affordable. I moved into a lower monthly housing cost and restored the brokerage transfer to $1,200. The bank had approved me for $480,000, and I had purchased at $412,000. Both numbers were financeable, but my affordable price had been $350,000 because it allowed the house and the rest of my financial life to coexist.